Welcome to Pindar Poetry. We hope you learned something new.
Decide married filing separately only when protecting one spouse from the other spouse's tax liability or when separate returns produce a lower combined tax. The married filing separately status uses the single equivalent standard deduction. It equals the single filer amount rather than the married filing jointly total. If you live in a community property state, you must allocate community income 50% to each spouse on their separate Form 1040. Compare scenarios with Form 1099 income, itemized deductions, and tax credits before choosing this filing status. Calculate both ways. Report only your wages, Form 1099's, investment interest, and deductible expenses on your individual Form 1040 when filing separately. Remember that married filing separately disqualifies you from the earned income credit and often limits other credits like the child tax credit and education credits. For deductions, both spouses must either itemize or both take the standard deduction. One spouse cannot itemize while the other claims the standard deduction. Gather W-2's 1099's, mortgage interest statements, and proof of itemized expenses to prepare accurate separate returns. Expect married filing separately to often trigger higher tax rates and reduced or lost credits versus married filing jointly. Calculate both filing statuses to compare total tax liability. In community property states, allocate income and deductions 50% to each spouse and document your method. Inconsistent allocation can trigger audits. Keep clear records of separate payments for medical expenses, charitable gifts, and unreimbursed business expenses to substantiate itemized deductions. If you change your mind, note that you generally cannot switch from separate to joint after the filing deadline without both spouses' consent, so evaluate carefully.
Thanks for watching. Consider subscribing if we helped you.